Good afternoon, ladies and gentlemen, and welcome to the Q2 FY23 earnings call of Pondy Oxides and Chemicals Limited, hosted by Alpha Street. This is Radhakrishnan Shonat from Alpha Street, and it's a pleasure to host Pondy Oxides and Chemicals Limited for their quarterly earnings results conference call. From the management, we have Mr. Ashish Bansal, Managing Director of the company, Mr. K. Kumaravel, Director of Finance and Company Secretary, Mr. Vijay Balakrishnan, CFO, and Mr. Piyush Dhawan, President of Commercial. As a reminder, today's call is being recorded. A replay of this call will be made available on Alpha Street India's YouTube channel as well as alphastreet.com/India, and a final transcript will be available shortly afterwards on Alpha Street India's website. May I now request Mr. Ashish Bansal to take you through the presentation, and post that we can start with the Q&A session. Over to you, Mr. Ashish.
Good afternoon, everyone. I wish you a warm welcome to POCL's Q2 FY22-23 earnings call. I hope that you and your family and everyone else is keeping safe and healthy. We will briefly discuss the results and the events in Q2, and post that we will have a question answer session. POCL has delivered a sustainable operating margin result despite the market nuances. In terms of revenue, there is a marginal increase of over 3% in the first half of FY22-23 versus the first half of 21-22, in spite of reduction in average LME by 7% during the said period. In terms of operating margin, the EBITDA, we were able to relatively maintain the same levels as previous year. We understand it is important to secure margins, and at the same time, we maintain economies of scale with respect to volume in the market. With respect to quarterly results, there has been a rational drop in the revenue in this quarter versus Q2 FY21-22. This is primarily driven by market factors with respect to volatility, market demand, and price fluctuations. However, it is important to note that since POCL has direct empanelment with OEMs across the globe, it gives us competitive edge in securing long-term contracts with a certain degree of fixed volumes. Despite price increases in cost manufacturing fuel, with global geopolitical tensions still prevalent in the forex movement being volatile, we should see a correction in the upcoming quarters to a certain extent. India continues to remain a focal point, which is substantiated by maintainable growth rate, GDP, and other micro and macroeconomic factors. I would like to reiterate that our focus going forward will be portfolio diversification and expanding lead recycling and manufacturing footprint. I'm happy to share with you that the announcement made in our previous earnings call will see the light of the day, and we will be the first company in manufacturing space to start with green lead technology, which not only positions us as market leaders in lead recycling and manufacturing, but also gives us the platform to walk the talk with respect to best environmental practices, sustainability, and corporate governance. We are entering different verticals in recycling of non-ferrous metals and plastics to not only diversify the portfolio in various segments in recycling, but also to ensure that the weighted average margins of POCL will drive upwards. We will see the aluminum division going live in Q3, which gives us edge in our product portfolio in the non-ferrous segment. Moving forwards, we will realize consolidated growth both in top line and the bottom line that will evolve over the next few quarters. And we will give shape to FY23. And furthermore to FY2024. In respect of our plastic division, we will appreciate the margins once our manufacturing facilities go live by Q4 FY23. In terms of operational performance, we had increased the smelting capacity in our plants and further have finished goods capacity for the manufacture of lead metal and alloys to the tune of 132,000 metric tons per annum. With respect to volume growth, the company has witnessed 20% growth in smelting operations in first half of 22-23 compared to the same period in the previous year. The import of scrap batteries has increased by 37% in Q2, consequent to which our smelting capacities see better utilization in FY23 compared to the previous year. We believe that redefining of battery waste management rules, extended producer responsibility, and stricter implementation of GST, the availability for these raw materials will increase further in the domestic segment as well. We have managed to have better control of our net working capital in September 2022. This improvement has been possible due to solid procurement in domestic markets, which reduces transit inventory. POCL has achieved a return on capital ROCE of 34% in the first half of FY22-23, and it is strongly in line with the expectations for the entire financial year. I would also like to inform you all that we have reduced our debt to around rupees 72 crores in the first half of FY23. This has happened because of a focus on reducing our working capital cycle. Solid business profile of POCL, which is supported by the firm's existing customer relationship, wide range of suppliers, reasonable entry hurdles, and proven production capabilities, forms the basis of this business strategy. Our fully owned subsidiary POCL Future Tech will be looking into plastics as a segment, as we will concentrate on specialized plastics as finished goods. With respect to announcements made in the stock exchange in the subject quarter, as committed, the team is working on proposal to list the equity shares in NSE, and in addition to the existing listing in the BSE. Bonus shares allotment has been successfully concluded. The business cycles specific to our industry and the overall industries in India and globally is undeniably operating in its own mysterious ways with respect to market demand and increase in prices of manufacturing. POCL continues to embrace such diversified opportunities in manufacturing and recycling with responsibility and commitment. Thank you, everyone, for joining us for this call. As you all know, given the past record of the company and the futuristic vision, we have a clear direction for future as we are optimizing the existing operations and venture into new opportunities and additional verticals. This would be a strong platform for us to expand our footprint across the globe. Over to you, Radhakrishnan.
Thank you, Ashish. We'll now move into our question and answer session. Today, we have participants joining via Zoom video platform and also via our telecalling platform. Participants who have joined us and connected with us through Zoom video platform can also post your questions on the chat box, and we'll ask the questions on your behalf. If you wish to ask a question directly, please use the raise hand functionality. I'll take a few questions from the chat box as well as questions we have received via email first, and then we'll open it up for the participants to ask questions directly. Once again, please use the raise hand functionality if you would want to ask a question directly to the POCL management. I'll start with the questions that we have received via email first. First question is, we are seeing a lot of headwinds in the global economy, like fear of recession. Amid these global cues, what is driving the improvement in revenue and profits consistently?
Radhakrishnan, yes, most of our exports are to the Asia Pacific region, Europe and USA, with strong focus on Southeast Asia. All the countries that are dependent on the region in and around the conflict have become more reliant on emerging markets or emerging countries like India, and hence increasing dependability on this region. Currently, the countries under conflict are not part of our addressable markets. Hence, this does not affect our business directly, but yes, indirectly, it has a strong impact in driving economic factors.
Thank you, Ashish. The next question we have received is, can you share the roadmap about how the company intends to grow in the future? Is the company planning to diversify into other recycling products?
So I'll take that question. Lead is a core vertical as of today and will remain an integral part forever. But diversification in other verticals is required to ensure that a business risk is mitigated and spread across to take on the volatility and demand supply effect overall. We have started sales in plastics, and full-fledged production will only commence from Q4 financial year 23. This will get added to our consolidated sales numbers in the financials. We're also looking to get into other verticals on a gradual basis, and this will definitely happen over a period of time, increasing our top line numbers.
Thank you, Piyush. Next question, how does the company plan to fund its capex?
Kumar will take this question. POCL almost a debt-free company as on today. This gives a strong platform for the investments in project for a better return on investments and equity basis, our weighted average cost of capital. We are planning to have a judicious mix of debt and equity, which is determined based on our payback period of respect to project, typically 18 to 24 months, return on investment and quantum of funding required for each project. We have a strong internal accruals over 200 crore. POCL plans to invest 90 to 100 crore in different projects, greenfield and brownfield in different phases through internal accruals, and depending on the market scenario, a combination of various debt instruments may be used from the domestic and international markets as may deemed fit.
Thank you, Mr. Kumarvel. The next question is, Does the company have plans to be debt-free in the near future as the debt-to-equity ratio is reducing consistently?
We do not have any such plan to reduce our debt level drastically. Short-term debt levels will increase if we get new orders for which we have adequate working capital limits with the banks. Long-term debts will be availed based on the future requirements for the new products, and accordingly, judicious mix of debt and equity will be decided in future based on setup of new verticals.
Okay, thank you, Mr. Kumarvel. The next question, what are the steps taken to control costs and improve margins?
I will take that question, RC. Vijay here. Our majority of costs comprise of material and factory overheads. Material margins are protected with appropriate hedging strategies. Continuous process improvements are done at factories in all profit centers to ensure optimum derivation from appropriate mix of materials. We are also in the process of implementing a new ERP to integrate and monitor the operational efficiency at all locations and monitoring optimum mix of materials in such products, especially alloys. This project is expected to go live by 1st April 2023.
Thank you, Mr. Vijay. Next question we have received via email is, over the years, the cost of smelting and refining, along with utilities like electricity, has increased quite a bit. Does the company have any plans to reduce them in the near future?
Costs are increasing due to supply chain disruptions and general increase in price levels due to inflation. Unlike commodities, these type of costs cannot be hedged. Such costs are being passed on to customers as and when our contracts are being renewed. Further, process improvements are also made at units to reduce the power cost by utilizing alternative sources of energy. We expect a correction in such costs in the coming quarters as part of business cycle. Furthermore, we are evaluating the impact of certain levels of automation that shall be increased in the upcoming quarters too.
Thank you, Mr. Vijay. We have a couple of questions that we received via chat. The first one, what are the projects in the pipeline for the year?
RC Aluminium division is expected to go live by the end of this month, and it will only shape up in the upcoming quarters as part of our phased strategy. Full-fledged production of plastics and the green lead project is expected to commence from the beginning of the fourth quarter for this year.
Thank you. Thank you, Piyush. The next question via chat we received is from Devesh Srimali. The question is, our contracts being long-term, how is RM escalations price pass-through negotiations coming through? Can you please comment on H2 23 versus H1 23 performance expectations on revenue/margins?
RC, basically, our RM costs to the customers are on variable basis because these work on LME-based contracts, and the average price of the month is factored over for the next month's supply. The fixed part is the premium part, and the complete part of the RM that goes, raw material cost that goes up in terms of how the LME moves or fluctuates or volatile is factored into the contracts pricing. Yeah.
Thank you, Ashish. Next is from Keshav Kumar. He has two questions. The first one is, what would be the levers of growth on a broad level for the next 3 years?
So we've already emphasized on the fact that product diversification is the need of the hour. And also we are kind of planning to expand lead recycling and manufacturing footprint globally and in India. So product diversification with a combination of non-ferrous plastics and other verticals where we are doing the pre-feasibility, feasibility studies and other segments will give us leeway into the growth strategy for the next 3 years.
Thank you, Piyush. Keshav Kumar's the second question is, would the new EU waste shipment rules affect the business going forward?
This is with regard to the plastics and lead, right? Can I get some more clarity on this question?
Yeah, sure. Keshav, if you can give us more clarity on the question, that'll be great. Meanwhile, ladies and gentlemen, if you would like to ask a question directly with the management, please raise your hand or leave a question in the chat box. While we wait for clarity from Keshav Kumar, let's take a question directly from Deepak Podar. Deepak, please unmute and you can ask the question directly.
Hello, am I audible?
Yeah, Deepak, go ahead.
Okay, thank you very much, sir, for the opportunity. Now in your remarks, you have been quite vocal about the product diversification. So anything on the lithium-ion battery recycling front we are looking at, because that would be a big market over next 10 to 15 years if one look at. Yes, that's my first question.
Yes, Deepak, thank you for your question. Looking into the lithium-ion space, currently we are in some kind of a pre-feasibility study and some R&D stage, because right now, currently, there is no specific technology that is sustainable for recycling lithium-ion batteries. And any company that is doing the recycling is also just able to, just break open and reach the black mass level and not down to the element structure. And so this needs little more of R&D to have a sustainable process going. So in fact, most of the companies in the space are still looking for sustainable processes, but including us. And we are doing our internal R&D on the same along with some partners.
Okay, understood. Fair enough. And my second question is related to your recent AGM speech. I mean, in which you mentioned that we are looking at in the plastic recycling business a 500 crores plus revenue with 12 to 15% margin in FY24, right? Can you elaborate more on that? I mean, is that what exactly we are looking at, and how will we be able to achieve that?
So, Deepak, what we are doing in plastics is going to be in a very phased manner. We are first concentrating, there are different kinds of plastic waste, right? PP, PPC, ABS, and other different forms. So what we are looking into is expanding up capacities right now from 1,000 ton per month to an increased capacity of 3,000 tons per month. The question that needs to be asked here is about the procurement and sales. Sales is not a, I would say, a significant part of it, because we already have a set customer base who wants to kind of cater to our manufacturing capacities. On the procurement side, we are looking at partners in India and across the globe to ensure that the plastic, I mean, the regrinds and all the other raw materials can actually be manufactured through pellets, and the entire concept of circular economy can be achieved.
Okay. Yeah, so understood. But are we looking at 500 crores kind of a revenue next year from this plastic only?
So yes, that will evolve only in the next 3 to 4 years. I mean, phase one is basically, sorry?
By 24.
So by 24, we are looking at, say, between 200 to 300 crores.
FY24, we are looking at 200.
No, not 24. The next 2 years, we're looking at 200 to 300 crores.
Okay. Yeah, that's what. Next 2 years, we are looking at 200 to 300 crores kind of a top line from this plastic division. And this 12 to 15% EBITDA margin in plastic division, that will kick in at what kind of revenue level?
Can you repeat that question? Sorry.
This for 12 to 15% EBITDA margin in this business will kick in at what kind of revenue level? I mean, will it kick in at this 300 crores level, or once we reach 500 plus, that's when we can see these kind of margin levels?
No, anywhere over about 150 crores plus revenues will kick in those margins.
Okay, fair enough. Understood. And my last query is related to your in general company level. I think we have been talking about EBITDA margin of 9% blended level by FY24, FY25, right?
Yes, that's right.
So how do we see that trajectory? I mean, like per annum from current 6%, 100 to 150 basis point improvement per annum for next 2 years would be a right kind of a trajectory one can envisage for the business, especially with the plastic also pitching in with higher margins.
So Deepak, the way we are looking at it is currently, of course, we have a lead portfolio. Apart from that, as Piyush just told about our subsidiary coming in on consolidated basis with plastics EBITDA adding on, and also our aluminum project, which is just kicking off in Q3 and will stabilize over the next about 2 quarters. So all these 3 portfolios put together, the average should start picking up as the revenues go up. So like you're saying about a 150 basis point and so on, the trajectory seems very practical.
Practical, right? Yeah. Fair enough. I understood. That's it from my side, sir. All the very best. Thank you.
Thank you, Mr. Lee.
Thank you, Deepak, for your question. Appreciate it. The next direct question is from the line of Vaibhav Badjatya. Vaibhav, please go ahead.
I hope I'm audible.
Yes,
Yes.
Vaibhav, you are.
Yeah, thanks for providing the opportunity. So this plastic business that you tell me about 200 to 300 crore revenue with 12 to 15% EBITDA, what is the total investments that we will be doing specifically in plastic business for to generate this around 250 300 crore revenue?
So Vaibhav, in the initial first phase, we are looking at an investment of about 10 to 12 crores. And as it goes on, the total investment would reach up to 30 to 40 crores over the next 2 years.
Okay, so 30-40 crore investment with kind of 12 to 15% EBITDA is quite a huge amount of money, to be very frank. So I'm just trying to understand why the whole recycling market will have plastic recycling market will allow this kind of return on equity or return on capital.
Yes, Vaibhav. So basically, the product mix that we are choosing are some specific products which are not run-of-the-mill vanilla products. They are more compounded products and more specialized products. And the reason why we need the next 2 years to scale up is because getting the right market size to use these products. So we are entering in with some specific products that are high margin products and not just the basic. Apart, the basic products will be a part of the portfolio, but the specific products are what we are targeting on.
Okay, understand.
So that is the whole idea here. Yeah.
And for lithium ion batteries, so is it not currently kind of possible even to manufacture lithium carbonate or other sort of cobalt by recycling lithium ion, or you think that is possible but we don't want to enter into that?
Vaibhav, definitely that is possible, but that is just a very base process, and we are looking at getting to the elemental stage where we can extract lithium and cobalt and nickel, copper, and so on. So we are more interested in getting to the end cycle of the stage, and we don't see too much extreme value addition in just recovering the black mass and giving it away and trying to use that or sell that. So we are definitely looking into the complete process, and probably in some time we should have some news on that.
Got it. So anywhere, I mean, India is pretty early in the EV space, but China is way ahead, and there are other countries which are also very forward in that sense. Anywhere you have not seen any lithium recycling to the element, to the stage where you want it to be?
No, currently we have not. Currently we have not seen at that stage, and also the whole supply chain of the lithium-ion business is not yet very mature in India, right. And the whole utilization. I'll say in the first 25% of its cycle where people are in the adoption stage. So recycling would really come in once the cycle gets over, the adoption happens, more people start using, and end of life, and after that it comes into the secondary market for recycling. So we still have that kind of a little leeway and time to get into the recycling part to have some volumes.
Right. Got it. Understand. That's it from me.
Thank you. Thank you, Vaibhav.
Thank you, Vaibhav, for your question. Appreciate it. The next person, Devesh Srimali, she has raised a hand. Please go ahead, ask your question directly, Devesh.
Hi, can you hear me all right?
Audio is a little feeble. Can you speak a little louder, please?
Yes, is it better?
Yeah.
Okay. Yeah, hi, Ashish. Congratulations for the good bottom line in a tough quarter. I have 3 questions. Right, first is more around our business model. You sort of explained that there is a RM pass-through based on the LME exchange prices every month. Could you help us understand, because we're right now...
Devesh, sorry to interrupt. It's a little unclear. We are not able to clearly understand what you're speaking.
Okay, let me try again. Is it better?
Little better.
Yeah. So my first question was around LME-linked price contract pass-through. Can you help me understand that? How did our revenue fall when the price through is linked to LME? Is it because volumes were same and the prices sort of came down? That's how we should read it. And how do we see that playing out in H2? That's my first question.
So, Devesh, here I'll explain. See, the LME by itself, in terms basically the formula works in the way wherein after the contract is made on month, the average price of the LME that is achieved is taken for the next month's supply. And if you notice, LME by itself has almost dropped by 10%. And apart from that, we have also specifically in terms of volume, we are more or less at the same levels of the previous quarter. But due to the drop in the LME, that also has reflected in a little drop in the revenues. Apart from this, also we have been little selective about certain products where we have the option to sell or not to sell. On those products where the margins were slightly lower, being a little tighter market in terms of raw materials and in terms of still having some shipping line issues and all of those. We chose those specific products which had a better margin and only shipped those out. So I'll say about most of the drop in revenues due to the LME price drop, but we've been able to maintain our margins by compensating by having the better value added products.
Okay, great. That's quite helpful. And Ashish, you sort of also called out that Q4 onwards we would have aluminium coming in and then plastic in the FY24. But between now till that point, how should we read H2 versus H1, assuming, with the assumption that lead prices stay and don't fall further from here? How should H2 look like compared to H1?
H2 and H1 more probability will look very similar, but we are hoping the H2 would be marginally better than the H1. In terms of aluminium, as you've asked, since the plant is just starting, there will be a little stabilization period, I say about 3 to 4 months, and we will really be able to see good numbers on aluminium maybe from the first quarter of next financial year.
Okay, makes sense. And last is more around the plastic part. See, there's another peer of yours called Ganesha Eco Recycling, who does plastic and primarily supplies to textile. Are we in the similar space? Will be our end user industries? Little bit more qualitative comments would be useful.
No, we are not into technical textiles. We are more into extruded molded products and those kind of products. Our end customers will be more who make extruded and molded products.
So which industry it would go to, if you can help us?
It can go to various industry. One primary industry could be our own industry where we're supplying our lead, which is the battery industry, furniture manufacturing. You have a lot of your flooring sheets. Even customers like, for example, there are many paint manufacturers who use those paint boxes where the paint is packed in all these box packaging industry and all of those.
Great. So it would mean that the initial ramp up could happen to our existing client base and relationship. We don't need to scout completely new set of customers. Is that right understanding?
Definitely, this gives us the basic, how do I say, the basic stability, because our existing customers are, our existing customers will be customers for plastic as well. So this gives us a basic stability to start achieving little more of economies, and then fresh customers will be added on to them. Like for example, right now we have battery OEMs who are already our customers. Then further, automobile industry would be our customer, appliance manufacturers, furniture manufacturers, some electrical and electronics companies, and so on and so forth.
Okay. Thanks a lot, Ashish. All the best. Thank you.
Thank you, Devesh.
Thank you, Devesh, for your questions. Once again, ladies and gentlemen, if you would like to ask a question directly to the management, please use the raise hand functionality. We have a couple of questions left from the chat box from Mr. Keshav Kumar. His question is, could you help draw plastics recycling supply chains going forward? Would the bottle manufacturers be responsible to source with EPR mandates and then we'll come in as a converter? And would that have materially shrunk working capital requirement as well?
Yes, currently in India, the EPR guidelines are being formulated and EPR is getting stronger by the day. Going forward, and we see that in the next 2 to 3 years, these guidelines will be pretty much stronger. And all the companies that need to use plastics for their packaging or in their products, primarily will have a compulsion to use certain percentage of recycled material to suffice their EPR requirements and so on. And once this comes in as a more stronger, more stronger rule and things, companies will reach out, and this will definitely create a new supply chain and will create a complete new cycle. And that definitely will be beneficial to the plastic industry.
Thank you, Ashish. Keshav Kumar's other question is, could you help segregate in percentage terms how much scrap is sourced domestically versus internationally? And would ERP help reduce the working capital stuck in supply chains to bring overall days down?
RC, are you referring to plastics now, lead now, or overall as a portfolio?
Yeah, the clarity is not there. So I'll again, ask
I
Keshav
can just
to
give out a brief understanding. This currently on the lead segment, about close to 70% of our raw material is sourced internationally and 30% from the domestic market. And apart from that, we also do some, tolling for some of our clients. And in terms of plastics, currently 70% is procured domestically and 30% is from various other sources. And going forward in aluminum, to start with, more material, I'll say about 90% or 85 to 90% should be imported, and the balance will be domestic. And slowly we will convert that cycle and try and drop down by 20-25% addition year on year for domestic procurement.
Thank you, Ashish. Appreciate that. We have a direct question from Rohit Ori. Rohit, please go ahead and ask your question.
Yes, sir, I'm audible.
Yes.
Yes.
Hi, Ashish, KK, Piyush, RC. Quite a lot of questions that I have. I'll ask them one by one. You did mention, Ashish, that 60% of the turnover is coming from the exports. I wanted to understand a bit more about the next round of price hikes that might happen, or in terms of the price negotiations that you might already be indulged in, or are you looking at the next month or the month after that?
You want us to reply one by one?
Yeah, please.
Okay, so basically, we are already in negotiation with our customers internationally on price negotiations. And we have, of course, most of the customers, or rather I'll say all of them, do understand the price increase and the costs of how the costs have escalated over the last 1 year. But definitely, as every buyer customer, there's always a negotiation where the customer tries to justify the cost not to be increased as much, and the seller will always want the best cost to be increased. So right now we are in the negotiation phase, and probably by end of this month, our negotiation should be completed. But whatever increase we are asking, we are definitely confident that at least 80% of that price increase will be achievable, and balance 20%, it will again depend on the market scenario, because at the point of conclusion, how volatile the market is, or where at those point in time where the energy or fuel or other additive costs remain.
Okay, so these generally the cycle is from is it quarterly basis or half yearly, or do you see the new price revisions in Jan then?
So basically, a typical contract with I'll say about 60% of our clients are a calendar year, which is Jan to Dec. And there are the Indian customers that we have are from June to March. Rather July to June. And there are certain customers in Southeast Asia where the contracts are from April to March.
Okay.
So it's a mix of overlapping contracts.
True. You did mention that there has been some change in the product mix, and then you are shifting more towards the value-added products. So if you can just take us through value-added products. When you say value-added, you are talking about the LME business, or are you talking about the plastic business?
On this way right now, because plastic business is just taking off. Right now, we are what we refer to was the lead business specifically.
Okay.
So when I say value-added products, I'm saying apart from the pure lead, which is the base commodity product, there are other specific alloys that we make, which go into specific applications and markets like in Japan and in South Korea and Thailand and so on. There in those alloys also, there are certain alloys which are little more technical to make, and not every company can manufacture those alloys. And those alloys were pushed in terms of volume as well.
Okay, so from the vanilla products as well as the value-added products, what sort of delta difference is there? If you can share between us, I mean, like if you can just share that number, the difference in the prices between vanilla and VAP.
I will say somewhere in the range of, depending on the product, it can be anywhere between 200 to 300 basis points.
Okay, okay. You did mention about future tech. By when do you think that the numbers will start rolling and start hitting the PNL?
A good level of numbers start hitting the PNL would be in the first quarter of FY, the next first quarter of the next financial year.
Okay.
So, and this will on a continual basis, this will scale up. You will see a little bit. I mean, you will see some decent numbers. I won't say something very extraordinary, but in the fourth quarter of this year as well, you will see some numbers adding on.
Okay. Ashish, nobody spoke about the copper operations. Do you think that there will be some more uptake that can come in the future in the copper business, or you're happy with the current capacity that you have?
Definitely, we are not happy with the current level of copper business. And right now, we were focusing a little more on aluminum and plastics. And in the next financial year is when we are looking at taking up and pushing the copper business as well. And as we do that, we'll keep you posted, because there are certain products that we wish to add in the copper portfolio.
Okay. Any guidelines on what sort of investment you might do, or what sort of capacity addition you intend to do?
Right now, we are a little bit in the discussion stages with certain experts and industry stalwarts. So once we are on that, we should be able to announce something good on that.
Okay. With these green lead battery processing, by when do you think that these productions will start kicking in, and then the benefits will start rolling out for us?
The equipments, that is the modules, will be installed in this coming month, that is by December. And the first phase of trials should happen by December end and first half of January. So I presume, on a very positive note, that second half of January to first half of February, we should have some greenlit products rolling out of those equipments. And once those are stabilized, we will be adding on more modules and slowly converting more of our furnaces to greenlit technology.
You did touch up on LME prices seeing a correction of 8-10% or so. Would you like to give any more guidance or outlook for the next 2 quarters? How do you see the industry panning out according to your estimates?
I'm looking at on an average basis of overall 6 months. We are looking, because what happens during December and winter, the demand kicks in a little bit more, European side and so on and so forth. And also over there with the energy costs and everything, the production costs are so high. So it is a little mix and match of market emotions right now. So I would say, more or less on a safer note, that the H2 in terms of demand should be very similar to H1.
Okay. Next few questions, KK, if you can chip in. You did mention that the debt burden has been reducing. We can see that the interest cost has also come down, and you are inching more towards the debt-free status, considering that you are working out with the working capital as well. But with all these expansions that are lined up, do you think that your debt levels will increase from here on, or are you happy with the kind of numbers that you are showing right now?
No, probably as mentioned, mix of both the debt and the equity we are planning. And for fixed assets, we are planning to go for some debt in different form, INR, foreign currency loan, something like that. And for working capital loan, whatever existing limit is just enough. Based on the turnover, we utilize the working capital limit wherever required.
So Rohit, it was not mentioned that we are working towards debt free. We are currently almost debt free. And that gives us a leverage to utilize our internal accruals and our reserves for projects in a much better manner. Hence, the debt taken probably could be little lesser than what usually any other company would take, and that would be funded by a mix of debt and internal accruals, is what was highlighted.
Definitely, we don't want to be the debt free. Otherwise, business cannot improve further.
True, true, KK. But any ballpark number you'd like to share that you will scale it up to 20 crores or 30 crores or 40 crores for the expansion?
Definitely more.
Yeah, definitely that range will come. 30 to 40 crore that definitely we take for long term. And the balance, depending upon the internal accruals, we decide the ratio.
Okay. And any plans to raise money via QIP or rights issue so that shareholders like us can chip in and kind of contribute towards the growth of the company?
Right now, no such plan. Then anyhow, board has to decide on this. Now, just now we completed the bonus share allotment. This type of rights and further IPOs we are not immediately looking at. But anyhow, this is board's call to decide based on the expansion plan in future.
Okay. KK, has there been any spillover of turnover, which was supposed to be for Q2 and moved on to Q3? If you'd like to share that.
It is a continuous affair. Sometime that week and month end, if we do some exports, as per the accounting standard, we cannot recognize that particular sale as a sale in the books. That will be pushed on to the next quarter. This is a continuous affair. It's almost in the same range of around 20 crore, similar every quarter.
Okay. Okay. And KK, any thoughts on JV or tie-up, maybe in the plastic or LME or maybe aluminum segment that you would like to share?
Definitely, that will be shared at the appropriate time after placing before the board, if any such news.
Any pre-feasibility testing that you have done, if you'd like to share with the shareholders?
No, but a lot of informal discussions are going on, but official decision not taken.
Okay, I understand that, KK. You mentioned that these plant for aluminium in Tamil Nadu, and you made an investment of somewhere like 5 crores or something. What sort of returns are you expecting from this investment of 5 crores, and what sort of sustainable margin do you feel that you can come? And this 14,750 metric ton, by when do you think that the entire capacity will be utilized?
The trial run we are planning in this quarter. Now, before December, the trial run will be over. Commercial production will commence from the fourth quarter of this financial year. And after seeing that, only exact quantum of return on investments and EBITDA margin we can say about it. It's similar to the lead only probably. But anyhow, we have to wait and see after the end of this financial year.
So I'll put it currently the aluminum margins will be like Mr. Kumaral said, very similar levels to the lead margin, because the metal recycling business currently entails only those levels of margins.
Okay, so Piyush, lastly, what I understand is that going forward, whatever POCL might do, that probably would be only profitable volumes growth that we should be factoring in, right?
Yes, Rohit. So what we expect to do is we are starting off with a pilot project for aluminium. There will be economies of scale wherein the margins will kind of pitch in. Similar for plastics and similar for our green lead project. So that is how we'll shape up and evolve over the next few quarters.
So Rohit, is your question that apart from these, are we looking at other verticals? Is that
yeah, that is what I mean. Like, see, the top line is not moving anywhere, but you are maintaining consistent margins of whatever 5-6%, and without growth in top line, it's indicating that the product mix that you are moving towards is giving you more bottom line. So with the vertical additions that might come in, or maybe with the current product mix that you are shifting or you're playing with, so that is the question.
Yes, Rohit, I'll put it this way. I mean, there cannot be a continuous vertical trajectory for any company I per se see. And once you reach a particular level and then you consolidate those levels, keep your margins intact. And meanwhile, you're also working on other projects that are being added and doing a little feasibility study on other verticals to be added. So there is always that little bit of that 1 year of consolidation where you stabilize and then have a stronger foothold to move ahead in a stronger manner. And for your question, where we are looking at other verticals, definitely, yes, we are looking at multiple verticals and we are doing a lot of feasibility study, and that is going on in the background. And at appropriate times, each of those verticals will be kicked off.
My last question is on guidance, if you'd like to share, because some of the other competitors were looking at 20-25% kind of a growth, and they have scaled it down to 18-20%. So do you think that the same will apply to us as well? I know you are conservative in terms of the guidance, and you would like to outperform whatever you will say. But then anything on the uptake, or maybe on the same lines, or will you maintain your guidance of what, 20% or so?
I'll put it this way, Rohit. Currently, the overall markets, not only the Indian economy, but the global economy is also in a very confused state of mind. And, every single economy is looking for direction. And amidst, these, turbulent times, I will not give a very extremely positive outlook, but definitely I'll say that whatever we have committed, definitely we will achieve, those growth numbers. But if you say, are you going to perform extraordinary over and above? I definitely will not be able to comment on that, because that has got a lot to do with the macroeconomic factors and a lot of external factors which are beyond control.
Ashish, you seem to be slightly cautiously bullish. I'll take it with that. Thank you for answering the question. Thanks a lot. Thank you, guys. Thanks.
Thank you, Rohit.
Thank you, Rohit, for all your questions. Appreciate it. Once again, ladies and gentlemen, if you have any questions, do raise your hand. And yeah, I see a couple of more raised hands. Vaibhav, looks like he has some additional questions. Vaibhav, go ahead.
Yeah, thanks for providing the follow-up. In earlier discussion, you talked about some revenue spillover. So just wanted to understand, is it like, what is the point of time when we decide that our revenue will be booked? Is it like moving out of factory gate, or generation of shipping bill, particularly for exports? Generation of shipping bill, or what is the point when we decide that now the revenue has to be booked?
Based on the bill of lading date, we decide the recognition of sale in case of exports.
Okay, bill of lading. Okay. And I don't know if I'm wrong. I read somewhere, or I'm wrong in my memory. Are you also considering to establish some operations overseas where you can, smelt or sort out batteries and then import? Are you considering those operations or not yet?
Yeah, we are looking for it, but still our board has not decided on those areas. Definitely, we are looking for overseas operation on effective cost of procurement of raw materials. That still board has not taken any decision on that matter.
Okay. Okay. Got it. That's it from me. Thank you.
Thank you, Vaibhav, for your question. Next question is from Muthukumar R. Muthukumar R, please go ahead.
Good afternoon, sir. This is Muthukumar.
Good afternoon.
Hello.
Yeah.
Sir, can I audible, sir?
Yeah, you are audible.
Okay. Okay, sir. I have two questions, sir. First thing, you have already said in the annual report that you have embarked on lithium-ion e-waste and industrial waste plan. Yeah, I just want to know what is the care expected in this three, that is a lithium-ion, pent-up demand for replacement, and e-waste and industrial growth. Care, that's also. And next thing, what is the top line and bottom line expectation for next 2 years? That's all, sir. Thank you, sir.
For the first part of the question, where we discuss about lithium-ion and e-waste, lithium-ion will start off as a pilot project. Along with that, we will have an R&D as a separate cost center in the coming 2 years. And as far as the e-waste is concerned, typically e-waste we have segregated into copper, aluminum, and the other different materials that come out of it. And India being the third largest e-waste generator and growing year on year with an organized capacity of 12%, we see that in phase 1 we will set up a pilot plant next year after doing a proper analysis and an operational break-even part or the payback period between 18 to 24 months. So right now it will be too premature, but yes, we are looking at those options to start next year onwards.
Okay, sir. And what is the earnings contribution we can expect from these three?
See, the pilot plants are going to be very small. I mean, if you look at the phase 1 e-waste plant, what we're looking at, that's going to be 2,000 tons per annum. So that's going to be relatively small. As far as the lithium ion is concerned, like Ashish had mentioned previously, shredding it up to the black mass level doesn't really make sense for us now. So we would like to kind of penetrate further into segregating the copper, cobalt, and other various metals. So as of now, I think over the next earnings calls, we would start elaborating more on the lithium ion and e-waste segments, because that will move from a pre-feasibility, feasibility stage to probably a stage where we can discuss more on this.
Okay.
With
And
regard to- yeah.
okay, yeah, and with e-waste and industrial waste, what is the capex or capex expected?
So for the pilot project, it will be about between 3 to 5 crores.
Okay.
Because that's more
Okay,
of
sir, that's
R&D
all.
facility, the pilot project. Yeah.
Okay, sir. Thank you. That's all.
Thank you.
Thank you, Muthukumar, for your question. Ladies and gentlemen, I'm going to give a few seconds to see if there are any more questions on the line. Again, if you have any questions, please use the raise hand functionality or leave a question on the chat box. I have one follow-up question from Deepak Poddar via chat. Any sense on revenue CAGR the management is looking at over the next 2 years?
So CAGR, we're looking at between 15 to whatever we have kind of promised in terms of the annual report and our commitment on the same. We're looking at a CAGR between 15 to 20% on the overall portfolio.
Thank you, Piyush, for answering that question. Ladies and gentlemen, that's all the time we have allocated for today. Please do send in your questions by email to us, and we'll follow up to get those answered by the POCL management. Thank you all for joining us for the Pondy Oxides and Chemical Limited Q2 FY23 earnings call. As a reminder, today's call was recorded. A replay of the call will be available on Alpha Street India's YouTube channel as well as alphastreet.com/India. A final transcript will be made available shortly on Alpha Street India's website. Thank you, POCL management, and thank you all the participants.
Thank you, RC, and thank you everybody for participating.
Thank you, everyone.
Thank you, and you may all now disconnect.